All right, welcome to another episode of the Legacy Wealth Podcast. Today we have on the show Cody Littlewood, that I know from GoBundance, and my co-host Mike Klein from Crypto Bull Capital. Welcome to the show, Cody.
Thank you. Thank you for having me.
Yeah, good to have you here in Colorado. You were originally coming out of Miami, so it's good that we got to snap you up. We got a little skiing in this weekend?
Yeah, we didn't have any skiing. We had a company offsite. I was going to be skiing today, but it's probably fine. We were up at Breckenridge, so going from sea level to 9,500 square feet, I think I would have probably been dying right now. So
well, you're less likely to get hurt doing a podcast.
Yeah, way less. Sure. Yeah, way less.
Yeah. So this show is all about helping accredited business owners understand everything about alternative assets. So anything that's a Regulation D style filing. And today we're talking to Cody about multifamily. So Cody, give us a little introduction about what exactly you do in multifamily, and then we'll dive in deeper there.
Yeah, sure.
And let's define multifamily for our listeners.
Okay, yeah. So apartment buildings. So we're specifically in kind of workforce housing apartment buildings, and so there is Class A. We're sitting in Class A, beautiful, brand new apartments. There's kind of Class B, like workforce housing, and then there's kind of Class C, Class D. Or affordable housing, right? And so I think sometimes when people hear workforce housing, they think affordable. Affordable, though, generally has some sort of government component. Like they give you a huge break on the taxes, a very specific type of debt. Maybe the government will actually co-invest with you. And it's really geared towards people that are making, $30,000, $40,000 or less a year. Our space is specifically like, we are like really middle of the road, people making $55,000 to $65,000, $70,000 a year. So people that can afford $1,300, $1,400 rents, and really that kind of middle of the road. So they're doing too well to have government assistance, but not so well that they can they can afford kind of Class A $2,500, $3,000 rents.
And that sounds like it's solving actually a really big problem and fulfilling a need. Like talk to us about that, and what does the average tenant look like?
Yeah, so this is it's pretty interesting, and I think it's a really good point. We don't talk about it enough, but there's no new supply coming online. Apartments, there's a ton of apartments coming online. But just as I talked about, right, you either, it costs about $250,000 a unit to build. Not something, super nice, right? Like, so Class A, very high end, for young, wealthy professionals, that's going to be like $350,000, $400,000 a unit to produce. But most Class A, or like kind of the A minus, $2,000 Sunbelt multifamily, garden style multifamily, it's going to be about $250,000 a unit to build. And in order for that to be profitable, you have to do one of two things. You have to rent it for $2,000, $2,200 a unit, or you have to have some sort of affordable component. So either the government has to kind of step in. And so there is a bunch of new supply coming on for people that can afford $2,000, $2,200 plus rents. And there's a bunch of supply coming on for affordable. So people making $30,000, $40,000 less. But there's no new supply because you just cannot build. You can't build for it, right? Because in order to build for it, in order to be able to have a profitable venture, right? And housing, right? We're incentivized. Both our investors are incentivized and we are incentivized to turn a profit. And so in order to turn a profit, you have to be able to get, for those rents, for $1,300, $1,400 rents, something like that, you have to be able to get into a unit for your all-in costs at like $160,000, $170,000, maybe $175,000, all in. And
you mean like for one unit in an apartment building?
For one unit, yeah, for one unit.
So if we're talking 100 units in an apartment building, it's 100 times 170.
Yeah, $17.5 million.
Got it.
So, so you just have to, the economics don't make sense. And so there's no new supply. You cannot build, right? No one can build for those costs unless we have a massive deflationary effect on land values, or construction costs, which I just don't see right now. There's no new supply coming online. And so all of our apartment buildings are in crazy high demand because we are the biggest segment of the market for renters, right? It's the market rate, people making $50,000 to $65,000 a year as a household, which is kind of your average median household income in most of our markets. But there's no new supply.
So we'll get kind of into your secret sauce, but it sounds like in this asset class, specifically this kind of strategy, it's really important to figure out your economics. But if you do, the advantage is you don't have a lot of competition, or maybe a better way to put it is it's really easy to have a high occupancy rate.
Yeah. You don't, I mean, there's a lot of other multifamily guys doing what we do. But so you have competition on the buy side, right? But you don't have competition on supply really.
Right. So you guys are really able to extract full value by having a high occupancy rate.
Yeah. We maintain really high occupancy on a stabilized property. It's probably sitting at like 98% occupied.
Okay, so what you're telling me here, so I have my prospective LP hat on.
Sure.
And I'm thinking, okay, Cody is, working in multifamily in a niche or a segment of the market where there's not a lot of supply coming on the market. And so when Cody and his team are able to get a deal that matches very specific buy box, they can churn out and be profitable because you have the system in place where that you can get high occupancy rates due to the demand in the market.
Yeah. So what we like to say is that we invest like wealthy families in America have invested for generations. So we buy well-located property in good growing markets that there's a supply-demand imbalance. We create and force value so we aren't affected by market fluctuations, and we hold for a significant amount of time, maximizing both tax benefits up front, but also tax benefits on your income and tax deferred benefits on your returns of capital. So
Cody has his pitch down.
I love it. Yeah.
Cody's nailed
got
it.
his numbers, man. Well, they believe in their strategy.
Yeah.
So this is kind of part of the show where we talk about just the asset class in general. Let's just talk.
Yeah.
Just spend a few, like a little bit on real estate in general. Then let's define, a little bit more multifamily, why that strategy is interesting. And
Sure.
Cody, do it from the perspective of I have some money. I want to invest it. I can invest it in any asset class. I can invest it anywhere. Why this asset class? Why specifically the focus that you guys have?
Yeah, I think it's a good question. I mean, I will say, I think you'll get some maximalists that will only, but I think real estate's just part of your allocation, right? I think you should be allocated to public markets. You should be allocated to private alts like us. And not just in the private alt space, not just us, but probably, you should have some exposure to, perhaps to hospitality, to retail, to oil and gas, et cetera. So, I think you generally want exposure to real estate or specifically multifamily. I think because it's kind of Maslow's hierarchy of needs, shelter. We feel pretty good about, regardless of what's going on in the world, people need roofs over their heads. We like it obviously for the, tax efficiencies on your income, as well as the ability to offset your other passive gains. If you have a spouse that's a real estate professional, you can also offset active gains. I think that in general, right, it's really kind of an income play. A cash flowing income play that is fairly well hedged against inflation, right? Inflation rises, rents rise. And it's a real asset. So I think particularly in an inflationary environment, I think that's very attractive. And I think just the track record of real estate in general, I think it's really attractive to be in the, it's shown itself time and time again. Yeah. I do like to say that, I think people often think that real estate appreciates. Real estate doesn't appreciate. I was telling you guys this earlier. Buildings depreciate, but land appreciates. So well-located land in good markets appreciates. And so I think you also have kind of that aspect. So that's kind of why I allocate to real estate. I like it. I like our specific strategy because it's not impacted by market forces. We control we force cash flow and force equity. So we're not trying to ride the market up. We don't rely on market forces. I think, if you look at, you could break down return summary on any asset class, not just real estate. And you could say, okay, what percentage of returns come from a specific business plan execution? What percent come from appreciation and, just general market forces? And maybe what percent of returns come from, I'm trying to think of another example, but maybe, tax strategy or whatever else. I would say like 90% of our returns, when we're projecting out returns, 90% of our returns come from execution of the strategy, not from market forces, like not from expecting the market to carry us up.
So there's a lot to unpack there.
Yeah.
I think most people are aware there's tax advantages. Let's start there for real estate.
Sure.
But they don't really understand how that works. And specifically, maybe as an LP in this fund, what's the benefit? How does that benefit you as an LP?
Yeah. So,
Give us some numbers. Like
Yeah.
invest
Let's break
100K.
it down.
oh, great.
And like, you know, I
Okay.
get it different
So
on
I'll
every
give you some
deal,
ranges.
but yeah.
Generally, multifamily, we are able to. So there's something called a cost segregation, or there's depreciation, right? So we have big advantages in depreciation. We can do things like cost segregations, where the first year that we purchase something, the study will come through and it'll say, okay, the walls have a 27-year lifespan, and so that's got a 27-year straight line depreciation. But your windows have a 10-year lifespan, and your fixtures have a 5-year lifespan, et cetera. And so it'll categorize things into different buckets, and it'll allow you to take more depreciation up front. And so you're able to offset it puts losses into your kind of your passive income bucket that you can use to offset real gains.
And just real quick, depreciation. Let's define that too.
Depreciation. So like, this mic is going to depreciate because there's going to come new technology. It's going to get used. It's going to be, there's going to be wear and tear on it, and it's going to depreciate over time.
So a $500 mic, when you buy it on purchase,
Right.
is now going to be worth $100 in 5 years.
Exactly. And so in theory, that's what the IRS is allowing you to do, is to offset the depreciating value of the real estate itself outside of the land. So the walls, the cabinetry, the flooring, the windows, the fixtures, et cetera.
Yeah.
And there's different schedules that you can do. And then also the the Tax Cut and Jobs Act also did something called bonus depreciation, which allows you to not only front load it into 5-year, 10-year, 15-year schedules, but allows you to take, I think, everything less than your 20-year schedule and take it up front in your first year. So right now you got to do 80% of that as of this year.
And so that reduces your tax liability.
It reduces your tax liability against your passive gains, unless you're an active real estate professional, or your wife is, or your spouse is. In that case, you can take it against active gains. And so I think sometimes, there are probably a lot of sponsors out there that say, oh, you'll offset your income. That's only true if you have passive income or you have a real estate professional in your family, so you can hit it against your active income. But for example, part of your passive income is going to be the cash flow from the property, right? And so you can generally totally offset all, so that cash flow that's coming into you from your investment into the property is totally offset by the depreciation. So it's tax-free income.
And let's define the passive income versus the active income real quick.
Yeah. So passive income would be, you invest with me as an LP, you collect what we call mailbox money.
Yep.
So that's your passive income.
Yep.
You go to your medical professional or a tech entrepreneur or whatever else, you have a W-2, that's your active income.
Got it. Okay. Helpful.
Yeah. So there's that. There's depreciation. So when you invest, say you invest $100,000 in a multifamily, right now you can probably expect around 50 to 60% of your equity. You probably expect a 50%, a $50,000 loss in your first year on your K1 that you can use to offset future income, current passive income if you have other investments that are passive, and you can use it to offset future income as well if you don't have it.
So for simplicity's sake, I invest 100K, 50% of it I get to depreciate in this mock scenario. I get 10K in cash flow from you maybe the first year, and I maybe sold another stock for a $40,000 gain. And now I can write off all 50,000 and not pay taxes on that 50,000.
Yeah, it'll depend on the gain, because passive gains are not the same as capital gains. But yes, but generally speaking, and ask your accountant. I'm not an accountant, but
not financial advice.
Yeah. So it won't offset capital gains, but it will offset other passive gains. And so it depends on the, I think it does depend on the classification, how your income's structured, et cetera.
Right.
But that is a huge advantage. I mean, as an LP, and I don't think it's like well known, is that you do get to like basically claim that loss right away.
Yeah, you get to claim a huge loss right away. You also get ongoing losses as you go. In general, right, those ongoing losses are going to offset your cash flow. You also, through the financing that we use, right, when you do usually we add value, the value of the property goes up, cash flow goes up. And so we then will refinance on the higher value and return a bunch of capital. And that is a tax deferred return of capital. And so that's very attractive as well. So say you invest $100,000, you get $50,000 of loss up front. In 3 years after the value add is executed, we do a refinance. I mean, obviously it depends on the interest rate environment. Maybe right now it wouldn't be 50% of your equity, but generally we're targeting kind of trying to return 50% of equity after the refinance. That $50,000 that's coming back into your bank account that you can go use to invest in other investments is on a tax deferred basis. So you wouldn't pay taxes on that.
And that's if you use it for any investment or for like investments?
No, any investment.
Any investment.
Yeah, it's a return of capital. It's a tax deferred return of capital. You could blow it on Vegas if you wanted. So.
Okay. not a high return investment.
Yeah.
Statistically, but you get to claim that.
Yeah, I love
you can
that.
do whatever you want with it with your return of capital. I think the point is it's a tax deferred basis, right? And so.
Yeah. Okay. Very cool. Very cool.
Yeah. So I feel like I'm pretty sold on you've been the best so far.
Well, you do love your tax advantages.
Yeah.
Well, but talk about, I'd love to hear from you why you like your tax advantages. Cause you're, high net worth, high income person. How do you think about like your taxes? I think not enough people focus on it.
Yeah. I mean, I don't think I've paid taxes in 10 years. I don't think I've ever paid taxes. Really. I mean, okay, I've paid taxes. Let's be clear.
I was going to say.
Like, I've paid W-2 income taxes.
Sure.
And I've paid active income. I paid taxes on active income.
Yeah.
But then, I have a lot of these capital gains, from selling stocks or from, that I've then offset from buying real estate. And I don't have to then pay taxes on those gains, and I can keep funneling that money into new investments without losing my basis of capital.
It's probably has a huge compounding effect, right?
Yeah, it does.
Yeah, Pascal's really actually got me onto this because I come from the venture world and you don't have a lot of these tax advantages.
No.
and I think it's one of the huge benefits of real estate that I believe, like I said before, everybody understands. Like they would, if you said, "Do you know real estate has tax advantages?" Everyone would say yes, but they didn't really understand how that works.
Sure.
And even down to the example we gave, I think that's really valuable when you're thinking about this asset class in general. So, okay, let's say I'm sold on real estate for all these different reasons. Why multifamily specifically? I think we talked a little bit about that. But if I'm the LP, I'm thinking,
sure,
just how's this sector supposed to perform over the next 10 years? Let's kind of slice it that way.
Yeah, I mean, I think that, like I said, we've talked about supply and demand. So I like being in an asset class where there's the impossibility of new supply, right? Or it's probably a little bit simplistic, but you generally get the point. The supply demand curve is very good in our particular multifamily space. There's a massive fundamental shortage of housing throughout the United States. And there are big demographic shifts that we like to take advantage, specifically in our markets, where there is and this has been going on. It was accelerated by COVID, but it's been going on for the past decade. If you read, there's a good book called Big Shifts, talks about demographic shifts in America. There's a massive demographic shift moving to, away from urban core centers like LA, California, et cetera, into Colorado, Denver, down from the Northeast and the colder environments into the more, business friendly, tax friendly, cost of living friendly, job friendly, and generally kind of red states with better weather. And so that is that's a huge migration trend. It hasn't slowed down. It accelerated during COVID. It'll probably slow back down to, pretty normal clip. But, it's always good to have, it's hard to fight market forces. And, like I said, I think we really like being, I'm not a super bright guy. I don't know if people are going to be like this app that I've created in 5 years or not. But I do know people need a roof over their heads.
Sure.
And so for me you're probably not going to produce 30% IRRs like you are in VC or in, certain, private equity. But I think you're going to, on a risk-adjusted basis, produce great returns, right? I don't think people look enough at, especially new LPs, they don't look enough at the risk-adjusted basis of returns, right? So,
what do you mean by that? Yeah.
I mean, everything is kind of based on a risk-free rate, right? The U.S. Treasuries, right? No risk, supposedly. We'll see if the debt ceiling defaults. Maybe there is risk, but there's a supposed risk-free rate, right? And the supposed risk-free rate right now on short-term bonds, say it's 5%, right? And then as you add risk, the markets are not perfectly priced. I don't totally buy into perfect market efficiency, but as you add risk, you're getting paid for that additional risk, right?
Mhm.
And so there's risk-adjusted returns, right? And I think that what you're looking to do is find the crux of the maximum returns with the minimum amount of risk. And generally speaking, I think that real estate, can produce these 15% IRRs while having pretty minimal risk if you're investing with the right people, the right strategies, and have the right kind of time horizon. You can produce excellent kind of risk-adjusted returns because there is kind of lower downside risk. There's minimal downside. There is downsides. Investors always ask me is this guaranteed? No, it's there's no, okay, yeah. If you want guarantees, go buy risk-free bonds. But if you want good adjusted returns, I think real estate's the place to be.
Yeah, it makes a lot of sense. Let's talk about, so somebody's sold on real estate and they think, I think this is a classic thought, is I'm going to do it myself.
Sure.
And they think I'm going to do what Cody does.
Yeah.
So
I'm
let's
gonna
talk
go
about,
buy myself a 5-plex or
sure. Like I get the value prop. I think it sounds easy.
Yeah.
So let's talk about, what it takes to do this full time as a professional.
Yeah. I mean, some people often ask us what makes us special. And I actually don't think our strategy is that special. In fact, our strategy is the least special, most replicable strategy out there. Anyone can go do it. You don't have to be a genius. You can go do it. I think that what makes us special is it comes down to our, for being kind of sub-institutional or institutional talent. But it really comes down to our team, our processes, our experience, and our, and just our time that's dedicated to it. So, I think that you absolutely can go do it yourself. The strategy is perfectly, you're perfectly able to go do it, but you better be able to, we underwrite about 2,500 deals a year, right? On market, off market. We have 5 people that are dedicated to calling owners and finding off market deals. We have an entire team of analysts dedicated to underwriting deals. We're looking at 2,500 deals a year, and we're doing 4 or 5. So it's about 0.008% of deals or something crazy, right? So we're doing 4 or 5 deals out of 2,500 that we look at. So if you're going to compete with us, you better be able to have a massive throughput, look at a ton of deals, have an entire off market team. We have institutional asset managers and auditors and analysts that look at that basically audit and question and manage all of our property managers to make sure that we're not missing a single beat. We have construction managers that are out there in the field managing construction full time. And I think at the end of the day, right, you really have to be dedicated to this. This is a full-time job. And if you're not going to compete with us at that level, I think you're better off finding somebody that can.
Yeah.
And I think that people oftentimes think that real estate's passive. I can tell you, if you want to run a good piece of real estate, it's anything but passive, right? It's the least passive. There's nothing passive about real estate in the world.
For sure.
Well, let's talk about let's talk about that active management. What's included in that, and also talk about the learning curve. You've had a ton of learnings along the way as well. I think of that as the cost of becoming the expert, right? And I think I think that's important, right? Because whenever you're talking to a potential, LP or somebody that's considering the fund, but they're considering maybe do it themselves, it's look, to get to where the professional already is, there's a lot of bumps in the road, and
loss of money,
right?
So
totally, right? That's the ultimate bump.
So I think that I've cleaned up a voodoo chicken, a lady who moved into an apartment and killed a chicken and smeared the blood into a pot because she was voodoo, whatever. There's some sort of voodoo thing that they do when they move into a new place.
Wow.
And you had to go clean it up. In my early days.
Yeah.
I wouldn't probably
But
be doing
that's part of the active management. You know, I think like you said,
Sure.
most people think I'm going to buy the property.
Yep.
I'm going to collect a check.
Or, and they think, oh, this Class D property, the cash on cash returns are like
great.
20%. They look great, but
Right.
they don't realize that like you haven't underwritten that there was a shooting here, and now you won't be able to lease an apartment at this place for the next 3 months until like,
right, or looked at the criminal score, the walking score.
Yeah.
Do you have the
Yeah.
best relationships with a banker to get like great financing? Or
Yeah, no, absolutely. And and so I think there's
Let's give some more of those examples. These are good.
Oh man.
Like something you go back and do differently, maybe.
Yeah, I think that it's man, I'm trying to think of all the things I would do differently. I think I would have never started out with I started out with smaller deals.
Yeah.
And like smaller deals are not easier, they're just smaller.
Right. Same amount of work.
everyone says this, bigger deals,
Bigger deal. And you work with better professionals.
Right.
Professional property managers, better lawyers, right? You aren't just working with some title lawyer. Not that title lawyers are bad, but they're not, our lawyers are making $50,000 on a deal, right? And so they are, they're the top of the top of the top.
Yeah.
Right.
You're working with better bankers. You mentioned debt, right? Like we can always get much better debt on a 200 unit apartment complex than you can on a 5-plex. So I think I would have started doing bigger deals sooner, and working with better professionals sooner. I think I probably would have paid attention. I made mistakes early on. We talked about it. Like you can, if you have enough money and time and patience and foresight, you can always change a property, but it's really hard to change unless you have as much money as God. You cannot change a neighborhood. And so I would have been much more, I didn't really understand, this is what we were talking about earlier, this looks like this has better returns on paper, but you don't realize all the things that come with it. It's really hard to change a neighborhood, and you can change a property. You can make a property the nicest property in a shitty neighborhood, but it's still in a shitty neighborhood. Right. So I think I would have paid a lot more attention to being in the right neighborhoods, in school districts where families want to move, in good household, meeting household income, understanding market dynamics. Are you on the right side of the tracks? Or you're on the wrong side of the tracks? So there's all sorts of stuff like that.
Well, I want to highlight something
Sure.
What does it take to get into bigger deals?
Other people's capital usually. So,
Right.
Yeah.
So
that's a big part of it. But also experience. So there is something to be said for, doing smaller deals on your own at first, because then you build the experience, you take your lumps, you lose your own money instead of other people's money.
Right.
People often ask, they're like, I understand the game theory around having skin in the game. Like it makes sense, but I actually am way more terrified of losing somebody else's money than my own money.
Oh, I actually
100%.
absolutely feel the
Yeah.
same way. Yeah.
Yeah.
I actually feel like I take even more precautions.
Oh, yeah.
Take more precautions.
Way
more
with
with
other
other people's money.
than
Yeah.
with my own.
With my own, it's everything on red.
Yeah.
So
Yeah.
no, it's
and I think that's important to highlight. So, the kind of like the parallel example is, a lot of people that want to do angel investing, they don't realize to get in some of the best or better deals, you have to be able to write a bigger check, and they may not be able to write that check.
Sure.
And so just what you said, one of the lessons you learned is I'd rather get in bigger deals, but in order to do that, you really have to even have your expertise and access to capital, and probably more capital yourself.
And that just takes time to build.
Right. And your LP that's considering doing that themselves, they may not even have that option, right?
Yeah.
Where they can invest a smaller check or the check that they would do themselves into your fund, and then they get access to those bigger deals.
Yeah. I mean, I had and also exposure to enough that it starts to make sense, particularly on the VC side, or the angel side. The other day I had an opportunity to invest in OpenAI, and it seems like a sure thing, but at the same time, I know if I'm going to, if you're going to angel invest, you got to have exposure to 20 deals.
Totally.
Otherwise,
Yeah.
it just doesn't make sense, right? Like,
And what are the comps? And you need to
Yeah. So I didn't do the deal because I'm like, I know I'm not going to go do 20 deals.
Right.
So I'm probably going to find a VC fund to put money with. And then I get exposure to those 20 deals and, exactly, exactly to what your point is, right? Then I also get exposure to better deals.
Right.
Right.
Because they're going to look at more deals.
Yep.
And same what you guys do, right?
Yep.
They're going to look at 2,000 deals where you might have time to look at 10 deals.
Totally. Yep. Absolutely. And they're gonna know the space. You cannot be an expert in everything, right? I mean, I'm cool if, I don't expect my mechanic to take out my gallbladder, right? And I don't expect my doctor to change my oil.
Right.
So having your expertise, knowing your expertise. I come from the software world. I built a software company before I started in real estate, and I love what I do and I love real estate, and I went into it for a very specific reason. But if I was just trying to get exposure to real estate, to allocate to real estate, I did the worst possible path. I should have just stayed in my lane.
Right.
And I built out my expertise. I took my lumps. I spent a ton of time and effort in it, and I love it. But if I was just trying to allocate to real estate, it was the worst possible way to do it.
But I think this is an important point, because, unless you're wanting to be the king or be really good at said thing and spend the next decade, it's really, hey, I'm just going to go buy a property and, futz around with this for the next 2 years. That's got to be the worst time investment, not even dollar investment, just time investment.
Well, side note, there's a book called So Good They Can't Ignore You. And
I haven't read it. I have it on my list. I have it on my shelf.
Yeah. So the sum of the book is essentially they follow these people, like the VP at a corporation that always want to be a yoga instructor. And they kind of track all these different people that shift their careers drastically to something that they felt like they had a big passion for. And what they find is that the life satisfaction isn't as great because they're going through those kind of bumps in the road, but also they went from being an expert in their respective lane to now being the lowest, like, kind of notch on the totem pole.
Totally.
And that's there's a mental tax to that, where it's like, I went from knowing everything about something to I know nothing about something.
Totally.
Yeah.
Yeah. And I think that, especially for really smart people that are good in an area, like, it's, they've always been winners. And so they're like, I'm going to go win at this too.
Right.
But it's like it's the worst investment on time. You absolutely, can you go do this and go be super successful at it? I think you can. I think that, like, real estate is really, like, you don't have to be that bright. But
there's still a learning curve.
Well, but there's a huge learning curve. Absolutely. Right. So it's like, you can go spend your time and go do it. And you could absolutely become good at it, but, like, what are you sacrificing instead? So, a good buddy of mine, he makes like a couple $1 million in profit on his practice. He's a specialized surgeon, right? And, like, is his time better spent? Like, is his time better spent building out his practice that is already massively profitable and adding a few more doctors and surgeons, et cetera, and opening a new location and doing what he's great at?
And he knows really well and has been doing it for the last decade. And
and then allocating with experts in their fields? Or is he better at trying to become a new expert in a totally new field?
Right. And also, like you said, if you just want to dabble in a new field, you're not going to have those returns. You're not going to have that performance.
Yeah. I think if you want to dabble in it because you think it'll be fun and it's a hobby, that's great. If you're a capital allocator, it's crazy.
Right.
So.
Yeah. I mean, I think we all have that friend or family member somewhere.
I mean, I've been there. I think we've all been there.
That just like, oh, I'm going to do this. I'm going to do that. And it's like,
I'm going to YOLO into bank stocks.
Right. I'm going to trade stocks for a while, or I'm going to, I can see this all the time in crypto. Like, I'm going to be in crypto, and it's like,
everyone went to crypto, right?
Yeah. Right. And it's like, okay.
And everyone got burned. So,
Right.
Yeah,
but I'm still a huge
they didn't
fan.
know what they were doing.
Yeah.
Right.
Totally.
No, absolutely. I think that, it's easy to do, but it's not a winning strategy.
Yeah. So let's talk about your firm and your guys' winning strategy. Cool. I know you said you guys have a simple kind of duplicative strategy, but it sounds like performance, excellence, consistency is what's really sets you guys apart.
Yeah. I mean, you also just before this, you even talked to us about how you had an offsite with your team and that, you're working with higher end people. Like, tell us about the talent you have.
Yeah. So I think that, what makes us special is not that our strategy is terribly special, right? We're selling toothpaste, and, there's all these benefits in toothpaste. If you use toothpaste, you live 10 years longer, et cetera. But at the end of the day, you're just buying fucking toothpaste, right? So, at the end of the day, I think that we're not building a better mousetrap, and we aren't claiming that we're building a better mousetrap, but I think we are focused on executing better, right? On being real operators, on investing in our business for the long term. there are in real estate, there are deal guys, and then there are people that are building firms and kind of holding company operating businesses. And deal guys are great. They've been around since, dawn of time. I'm sure you guys know a couple of deal guys, but it's hard to support a bunch of outside capital that way. B, it's hard to scale that way because it's basically all reliant on a single principle. And C, it's really like there's a magic. It's more of the art instead of the science.
Well, for the audience, define what you mean by deal guy.
Like a deal guy, does maybe like 1 or 2 kind of unique deals a year, relies on a handful of broker relationships, and
has a contractor that he works with.
Will pull in some friend and family money to do the deal, et cetera. Most of the deal is like based on his unique knowledge of the market.
He's probably doing something else.
He's maybe doing something else. Yeah, absolutely. And those guys are fine. They make a bunch of money, and they do. But I think that over time, I think we will beat those guys every single time, and we will definitely grow faster than those guys every single time because we are investing like those guys. It's like one guy and maybe like a bookkeeper.
So a deal guy may come to you and say, hey, it's been 6 months. I have another deal. Do you want in? Let's talk about how you guys are different than that.
Yeah, I mean, so we, we're a little bit more programmatic. So we first off, we invest heavily in our talent. So we have an asset manager that came from DRA who used to run a $750 million book of deals, right? We have I mentioned earlier, right? We have dozens of analysts, not dozens. We have a dozen analysts in different, either in the acquisition side or in the asset management side. We have VP of acquisitions that came over from, a large institutional player. We have a VP of investor relations and capital formation, also with like institutional background. So I think what kind of makes us unique is our institutional approach at a sub-institutional scale. And so our nimbleness and that, our return profile, because we're going after kind of the sub-institutional deals and have a higher cost of capital. And we're producing kind of higher returns than the institutional class is, but with the institutional kind of quality of talent, of processes. Like, for example, I know a lot of guys in our space and I talk to them. And when I talk to them, they're looking at like valuation on very simple terms, right? My partner, you're good friends with my partner. He's an ex like JP Morgan fixed income trader, worked in private equity with BlackRock and Deutsche Bank and like a whole bunch of other things. And he has a 175 point matrix on how we look at valuation and basis on a deal, right? So, so you're getting kind of a really high like institutional class, set of processes, execution, and talent. But while still, you can still write us a couple $100,000 check and we'll take it, right? The institutional guys won't call you back unless you got $1 million.
So it's like for your check, you get access to that whole team.
You get access to that whole team.
Yeah. And something we like to talk about here is that when you're hiring, when you're investing in a fund, you're doing what all the wealthiest people in the world do is they're farming out their time. They're hiring experts on their behalf to manage their money.
Yeah.
Yeah.
Yeah, no, absolutely. And so we are, we're also moving towards like a fund strategy as well. I think you mentioned like, is it just, every 6 months I got a deal? No, you can invest into a fund, you get risk adjusted returns across a set of assets, even if, we've never had an asset go to zero, but you do have, if you have an underperforming asset or something that is, that is equaled out by having a higher performed asset. Right. And so you kind of get that kind of risk adjusted returns by having the exposure to several different deals, even if you're only investing a couple $100,000. Normally, if you're, you'd have to invest, let's say you'd have to invest maybe over 5 deals that a fund has exposure to. You'd have to invest $500,000, but you can easily have access and have that exposure to those 5 different assets with a couple $100,000 check with a fund strategy.
I think that's worth highlighting. I didn't realize how much of real estate was a deal by deal basis.
Tons.
And I think that puts, if you think about the value add that you guys bring in terms of all the deep dives and the work you do, I think like when I think as an investor, if somebody presents to me, well, okay, we're going to do 10 different deals. Which one do you want? That almost defeats the purpose because it's like, well, now I have to choose. And so it's very interesting to highlight that you guys are moving to this fund model. And for the audience, that means, you're going to have 10 or 20 or whatever the number is investments within that. So you're investing in all those. Your money gets spread out and you diversification, which is, I think it's a lot better because you don't have that pressure and anxiety as an investor. Like, did I pick the right one?
There's trade-offs, I'm sure, I know people that invest in a certain syndication because they know, and a syndication meaning one project or one apartment building, because they know Denver really well. Like, I've invested in a syndication here in Denver. It's like, I know the location really well. It's a couple blocks from here. I know the area. It's like, I know the neighborhoods, like you've been talking about, like all of those things. And so that felt like a much more comfortable bet for me to make. Whereas pretty much in all of my other investments have been funds.
Yeah. I think there's a time and place for both. I think that it goes back to what you were saying earlier, though. Like, do you think you're going to be better choosing deals than I am? And like, maybe you are. Like, I don't know. Like, and I'm not saying you particularly, but like an LP, you as an LP.
Cody, you'd probably be better at picking deals than me.
I don't know. Not in Denver. But I think that's often, we have some large family offices that invest with us. And at the end of the day, what I was talking with them about, they want to look at every individual deal.
Sure.
Like, we don't want to come into a fund. We want to look at every individual deal. And at the end of the day, and now they've kind of come around. I'm like, do you think you're going to be better at choosing deals than us? Because, and we talk about we just talked about like the expertise and the team, et cetera. And it's like, you guys are allocating to a specific strategy. And at the end of the day, you're allocating to an operator. I think everyone thinks they're going to underwrite a deal, but I don't think you can underwrite a deal better than we're going to underwrite a deal. And honestly, if we want, if we wanted to hide something, we could hide something, right? Every single operator, every single GP sponsor can. And so at the end of the day, you're really investing in an operator. You're investing in, their honesty, their integrity, their ability to execute. And it's highly unlikely that you're going to be better at deal selection than they are, or that you're going to have a asymmetric set of information than they are. Right. Like I said, we would never hide information, but I'm just saying from a pure logical perspective, right? We're always going to have an information symmetry to what you have, right? Because we just have access to much more information. So,
you have a whole team gathering information.
And we have a whole team.
And analyzing the information and going through it. And,
Is that transition from syndication to a fund like the natural progression as an operator that's doing well?
I think so. Yeah, I really do think so. I think it makes a lot more sense for an operator to have a fund versus have be on an individual deal basis. There are probably some downsides to look out for. I think that, for example, sometimes what people worry about is if you have a fund, you have an incentive to get capital out, even if you don't have good deals. And so, we like to we're doing something kind of interesting on our first fund where it's a little bit of a different setup where there's no incentive to kind of get money out on any specific time period. But the other thing that you can do, you can look for in a sponsor is, does my promote just accrue on does accrue on committed capital or just on contributed capital? And so if it's just on contributed capital, well, then they don't have an IRR drag. So they don't have the incentive to get capital out, on a specific time frame, even if the deals aren't there to be had. And you would want that in a situation like last year where there's a huge bid-ask spread where buyers were like, my cost of capital just, tripled. But sellers were still stuck to the old prices.
Right.
And like I said, last year we thought we were going to do 4 or 5 deals and we did 2. So you definitely want to watch out for that. Make sure you have like the right incentives. But I do think that, fund structures, in general, I think it's probably it makes a lot more sense on an execution basis than individual deals. You can focus on fundraising while you're fundraising, and you can focus on execution while you're executing. And you don't have to, try to do both at the same time during an acquisition, which can be really stressful.
Any other kind of questions you have?
No,
anything you want to make sure that we've covered that we might have not talked about?
Yeah, I don't really know. I think that, we could probably talk about market timing.
Okay.
Yeah, I would love that.
Really quickly. I think that a lot of people that I talk to that are not professional allocators are like, are really nervous. Like, if I wait, are there going to be better opportunities?
Right. Or I'm waiting. I'm constantly waiting.
I'm waiting. Right. Yeah. I've cash on the sidelines ready to deploy.
Right.
And I think that, one, I would say that's the benefit of a fund. I would say the second thing is you never really know where a bottom is. And if you're a serious capital allocator, I think what you're looking to do is to deploy into good assets at a fair basis with a long-term time horizon and to execute on a great strategy, right? I think Warren Buffett, consistently says, like, listen, if we could time the market, we'd be trillionaires, right? But what we do is we find good assets or, good companies with wonderful operators and management. And we buy it at a fair price and we hold it for a very long period of time. And I think that, if you are a serious capital allocator, you're always in the market, you're always, you're always doing deals, you're always doing opportunities, and you're looking to buy at a fair price. You're looking to buy great assets at a fair price, fair basis, and, hold them for a very long period of time. I think that there are probably different vintages that produce different results. 2023 to 2024 is probably going to be some of the best vintage that you buy. 2021 is probably going to be, vintage that, is not going to be as, it's not going to have as immediate high of returns because you're paying a higher basis, but it's going to produce excellent returns over the next 5 to 7 years. And so I think that, you always want to be in the market as a serious, allocator. And I don't think that, you're probably not, I think you're probably not right now, right? For example, who knows, right? Maybe the market dips another 20% or, another 10%, but I can tell you it's already dipped 20% off the highs.
Right.
Right. So like, am I going to time it? Am I going to hit the perfect bottom in that market?
And you should be dollar cost averaging.
Yeah. You should be dollar cost averaging anyways. So I think that's a question we get a lot is like, is this the best time? And we're waiting for the fallout.
Right.
And
it's interesting because always as a GP, or I could imagine, I sitting here as the LP, you sitting there as the GP, I ask you this question. Of course, whatever answer you give me, I'm going to think that you're biased because you want me to put money in the fund. But really it is like, I'm still making investments now. And I was making investments before the crash. Like,
yep. And I'm not just saying real estate. I'm investing, like I make LP investments and I'm investing into tech right now.
Yeah.
In fact, I think it's like a great time to be investing in tech, right? Like, so
100%.
So everyone's, the funny thing is everyone always says I'm waiting for distress, but when there's real distress, they're too shit scared to deploy.
Yeah.
It's really hard.
There's huge distress in tech right now. Like, what are you talking about?
I see this with obviously with crypto, right? Yeah. You have these big waves and, it's just so fascinating to me. It's also interesting how an LP will think, which I think this is wrong as an LP. Yep. They'll think I'm timing the market by timing an entry into a fund.
Yeah, that's
and it's sort of like, no. Like
our investment period is 2 years.
Yeah, if you trust the fund managers, they're going to be deploying and kind of, timing appropriately. Like they have a whole team figuring that out. And it's not like you write a check and they're just everything's deployed in the market
next day.
Yeah. But a lot of people don't think that way. And it's like you said, the Warren Buffett principles, it is the easiest. So a lot of things in life are simple, but hard, right? It's the easiest thing to say, I'm going to, sell high, buy low. I find that very few people are able to buy low because they're always worried about going lower.
Most people do the exact opposite.
Right.
2021, everyone was clamoring to get in at these crazy high prices in every asset class, right?
Yeah,
like real estate, crypto, tech, whatever. But now that everything's down,
totally,
they're scared to do it.
But if you had asked them in 2021, hey, if this asset is now 20% less, they'd be like, oh, I would buy more of them.
Yeah.
And then it's like, but they're not buying any now. Because it's hard. It's just hard.
It's really hard. I mean, investor temperament, like your temperament as an investor is going to be a far higher indicator of returns than your selection.
Yeah.
I think. And, having the ability to deploy when everyone's scared, being greedy when everyone's fearful when everyone's greedy. It sounds easy, but it's actually really hard. We have this joke in real estate that everyone wants to invest in distress, but they all want distress to look like Class A multifamily that's 98% occupied, not office, which is getting fucking hammered right now.
Affordable housing,
or affordable housing. Yeah. This funny, weird like psychology that I want to invest in distress, but like only if distress looks like this pristine asset, which is not distress.
Yeah,
so, right.
Anyways.
Yeah. Well, this has been awesome.
Yeah, thank you.
Thank you for coming on.
The show.
My
Thank
pleasure,
you.
guys.
Yeah.
It was a lot of fun.
Thank you for having me. It's good to see you. Good to see you again and good to meet you.
Yeah, pleasure.